The average individual investor underperforms the market by nearly 4 percentage points annually. Not because they pick bad investments, but because they buy and sell at exactly the wrong times. The data is clear. Most beginners lose money not from what they invest in, but from how they behave while investing. By the end of this video, you will understand the 5 most common mistakes that cost beginner investors real money. See how modern AI tools are designed to counteract these specific behaviors and have a framework for building a more disciplined investment approach. Whether you are just starting or refining your strategy, these patterns matter. One important note before we continue. Everything we discuss here is purely educational. This is not financial advice, and I am not your financial advisor. Markets involve risk, and your situation is unique. Do your own research and consult with a licensed financial professional before making any investment decisions. The first mistake is emotional trading. Buying when markets feel euphoric, selling when fear takes over. Research from Dalbar shows this behavior gap costs investors significantly over time. Your brain is wired for survival, not portfolio management. When markets drop, the instinct to flee feels rational in the moment. This is where AI tools offer a structural advantage. Platforms like Betterment use algorithmic rebalancing that operates without emotion. The system follows predetermined rules regardless of market sentiment. It does not panic during corrections or chase rallies. This removes the human impulse from execution. Some investors find this automated discipline helps them stay the course during volatility. Consider whether removing yourself from day-to-day decisions might benefit your long-term approach. The second mistake is attempting to time the market. Studies consistently show that missing just the 10 best trading days over a 20-year period can cut total returns nearly in half. The problem is those best days often occur right after the worst days, when most people have already sold. Past performance does not guarantee future results, but the historical pattern is striking. AI-powered platforms like Wealthfront approach this differently. Rather than predicting short-term movements, these tools focus on continuous investment through automated deposits, regardless of market conditions. This systematic approach, often called dollar-cost averaging, reduces the pressure to guess correctly. The algorithm invests consistently, whether headlines are optimistic or alarming. For many beginners, this structure removes the temptation to wait for the perfect entry point that rarely comes. The third mistake is inadequate diversification. Beginners often concentrate heavily in familiar names, companies they use daily or hear about constantly. This feels intuitive but creates significant concentration risk. A single company's poor earnings report can devastate an undiversified portfolio. Modern AI tools can analyze portfolio composition and flag concentration issues. Platforms like Empower offer free portfolio analysis that examines your holdings across sectors, geographies, and asset classes. The dashboard visualizes where overlap exists and where exposure may be lacking. Some robo-advisors automatically spread investments across hundreds or thousands of securities based on your risk tolerance. This systematic diversification is difficult to replicate manually, especially for beginners still learning how different asset classes interact during various market conditions. The fourth mistake is underestimating the impact of fees. A 1% annual fee might seem trivial, but compounded over 30 years, it can consume nearly a third of your potential returns. Many beginners focus entirely on performance while overlooking what they pay for that performance. AI-driven analysis tools help surface these hidden costs. Platforms can scan your existing accounts and calculate the true fee burden across all holdings. Some robo-advisors operate at significantly lower cost than traditional actively managed funds. When evaluating any investment platform, examine the expense ratios of underlying funds, any advisory fees, and transaction costs. Small percentages become large numbers over decades. Understanding your total cost of ownership is fundamental to building wealth efficiently. The The fifth mistake is investing without a defined plan. Without clear goals, time horizons, and risk parameters, every market movement becomes a reason to second-guess yourself. This uncertainty leads directly back to emotional decision-making. AI-powered platforms typically begin with structured questionnaires that establish your objectives before any investing occurs. They assess your timeline, income stability, and psychological comfort with volatility. Based on these inputs, the algorithm constructs a portfolio aligned with your specific situation. This creates accountability. The plan exists independently of your daily mood. Some platforms like Betterment even offer goal-based tracking, showing whether you are on pace for specific objectives like retirement or a home purchase. Having this external structure helps many investors maintain perspective. If you are exploring platforms to begin your investing journey, Robinhood offers commission-free trading and has introduced some automated features worth examining. You can find them at robinhood.com. These tools are starting points to explore, not definitive solutions. Evaluate what fits your specific needs and goals. Let us recap the 5 mistakes and their solutions. First, emotional trading. Automated rebalancing removes impulse from execution. Second, market timing. Systematic investing keeps you consistently deployed. Third, poor diversification. AI analysis reveals concentration risks you might miss. Fourth, hidden fees. Transparency tools calculate your true costs. Fifth, no investment plan. Structured onboarding creates accountability and alignment. Each of these mistakes is behavioral, and each has a structural solution. If this was helpful, leave a like. Subscribe for weekly insights on building wealth. In the comments below, share your biggest investing challenge or question. I read every response and often address them in future videos.